In this video, traders, we're going to look at the key differences between calling a trade and actually making it. Stick around for this one. Hey guys, a warm welcome to you. All right, thank you so much for joining me, and those of you who are subscribers, long-term subscribers, do appreciate your support, appreciate you liking, sharing, subscribing, commenting, all that kind of good stuff. Hopefully you're getting some value from these videos. And let me know what you want to see more of, by the way, in the comment section below, and any of the videos, we'll pick it up, come to me, and we can have a look through and see what you guys like to see more of and what you prefer not to see some of. All right guys, so let's get onto it. So how we look at a price, or how we kind of make a trade call, is very different from if we're actually taking the trade. So example here, the reason for doing this is that so often I see people who bid themselves too much, and that also can be yourself. Listen, I've probably been guilty of it myself, for calling a direction on something. I knew that Bitcoin would go down, I knew that oil would go down, I knew that gold would go up, or whatever it may be, and giving yourself too much credit for something that's not really that good. Right? It's very easy to stand there and make a selection of calls. I could literally toss a coin now in each market, make the calls, and I know that majority of at least half of them, to be honest, are going to come true, right? And then I can go, oh look, I knew that gold was going to do that, I told you it was going to do that. It's irrelevant, guys. Making a call, a prediction, is useless in the trading world, because it's how the price gets there. This is the perfect example that I've used before. I've talked about in little bits and pieces, but I really want to talk about it in detail now, because there's a psychological element to ourselves, which we'll get to in a moment, and it's not just other people we're worried about here, because who cares what other people do, to be honest. So it's looking at this and going, right, I think the price is going to hit that level, and that's even going one step further than most people. I think it's going to go up. Well, you know, it goes up 10 pips, you're a hero. No, not really. So let's say this goes to that level, but let's say that's 250 pips away, but let's say the market falls 250 pips before it goes up and tags that level. Is that really a good trade? Well, it's not the greatest, because if you've got a 1-to-1 risk reward ratio and it goes down, you're going to get stopped out of the low, you're going to lose 250 pips on something that was right. So, and we could kind of extend that and say it goes down 500 pips before it goes back up. So the point is, guys, is it's all about, you know, how the price gets there. And I could have multiple examples of this. You could say, okay, it goes up there, almost hits the target, then goes down by 500, then goes up, almost hits it down. You know, you're sitting there for months and finally get that last 10 pips. Is that the way to trade it? No, it's not the most efficient way to trade it. So, you know, it's how price gets there is so important. And yes, I do believe that we should have a bias and a thesis. I think the market is going to go from here to here, and that's the initial seed of the idea. But that's where a lot of people leave it. They go, it's here to here, and they're just going to trade it. And that's obviously where they get stopped out regularly, and they get frustrated because, and this is it here, don't let the calls influence your next trade. You get frustrated because you say, well, I think the price is going to go here, and it's not necessarily your directional call on the market that's poor. You may be very, very good at calling direction. You might find that, hey, actually, you know, I'm getting, you know, 8 out of 10 of my directions right, 9 out of 10. It's not a challenging thing to do. It's a good start, and of course you need some experience for that. But the point is, you get frustrated because it hits your target later on in the week or in the day, whatever it is, and you've been stopped out or you haven't got on it or whatever, and it kind of influences your next trade, because you then go, well, I'm going to take the next trade quicker than I should do because I was right the last trade. Gold did go up, or Euro USD did have an up day or a down day. I was correct in my thinking, so I'm correct. I'm going to take the trade regardless. And there's one extra step that's so important. This is the key difference, or one of the key differences, guys, is that you're finding a place to express the trade with a managed, sensible risk is the ultimate sweet spot we're looking for. Okay, we've got our thesis, market's going to go up, market's going to go down, whatever it may be. Now comes the challenging part. Now this separates the profitable traders from the losing traders, the consistent traders from those who are spinning their wheels and constantly getting kind of some traction and losing it all again. It's understanding a sensible way to express the trade, and that might not always be available to you, and that's a fact you're going to have to deal with. We have to deal with this as traders. This might just shoot off that target and give you no place to get in, because you're looking for a sensible place to make the trade where an obvious stop loss can go. So if we look at this example, you might say, right, well, where's a sensible place to take the trade? You could kind of go, right, well, I'm going to take it on this little pullback after a drive. Let's imagine we've kind of broken this downtrend line. One example, we could take it when we finally break the high here, or maybe when we break the open level here, or we could buy a pullback after a breakout consolidation. There's multiple ways of doing it, and I'm not here to kind of say which one's right and which one's wrong, but the point is, for each one of those, we've got a specific entry point, which we call a trigger. We've got a specific place to put the stop that makes sense for the thesis. So we're combining two things together. One is we think this market's going to go up and hit the target. And two, this is the actual trigger pattern that we're using. And this is the stop that we use with that trigger pattern. So when we combine those two, all of a sudden we have much more of a powerful trade, much more of a trade that's likely to give us a positive expectancy over time. Now, it may still not hit that target, but the point is that with the risk reward ratio skewed in our favor, we don't have to be right that much. We can be right almost 50% of the time. We've got a good risk reward ratio. And it's not quite as simple as that, but we're along the right lines now and we start doing that. So in always be looking for a good risk reward ratio on the trade. So the thing is, guys, is this kind of mental checklist. You go, okay, have I got a good idea of where the market's going? And it's okay if you don't. You know, many times I'll sit down in front of the market that I'm very actively trading. I'll look at it and go, do you know what? I don't know where this is going today. I've got no real thought. It could go lower. I've got a bear thesis, I've got a bull thesis. I'm gonna have to give it the first couple of hours and see, you know, if I can get a better feel for it. And if I can't, I'll leave it for the day. You know, I'm not going to try and force it. Other days I'll come in and go, you know what? I've really got to feel that we're going to come down, we're going to tag that level and I'm going to rip off. That's my trade plan. And then I'll say, well, how can I express that? Well, I need to wait and see that first low put in. Then I want to see what happens with the second low. If I can work a long position off that second low using the first low as a reference point, as a stop, then I'm going to trade it. And you start to come up with these ideas. And sometimes the price just goes and like, it's going without me. It's going to hit that level. Bang, it fills a gap, or it hits the overnight high, or it hits your key level or whatever target, and doesn't give you one of those options to get in. And that's fine. You know, you just go right and your journal, call the direction, couldn't get a trigger, couldn't get an entry in it, next. You know, wait for the next cycle, whether that may be the next day, the next week, or the next kind of few hours, if you're splitting your day trading session from morning, kind of lunchtime to afternoon, whatever that may be. So guys, sort of summary of this video is not enough just to call the trade. Always be thinking about how you can express the trade in the least amount of risk possible, but sensible risk. Not just saying taking a trade and putting a 6 pip stop and hoping it doesn't get tagged. Having a sensible stop based on what you've seen and based on one of the patterns you like to trade, whether you're trading indicators, whether you're trading price action, whatever, it doesn't really matter. And then putting those two together is much, much more powerful. And then also the other thing is just be aware, you know, we've seen people calling things and this and that and the other. And yeah, you know, how much risk did you have to take? How much unrealized loss was on the books before we finally got that? You know, we know, guys, you're at the front line, you're trading every day or every week or regularly. You recognize that this is not as easy as just calling direction. So think about that direction plus your setup, put them together. It starts to get a little bit easier. It starts to become a little bit kind of kinder to you as well. You're not beating yourself up all the time for making a call and not getting it, or even worse, making a call, getting stopped out of the low because the stop wasn't quite right. You couldn't stomach any more pain, and then it went off without you because your timing was just a little bit early. All right, guys, take care, keep your risk managed. Whatever you're doing, make sure you are subscribed, of course, to the channel for more videos from me and others. Take care. Bye-bye.